Should you be saving in a Roth account, like a Roth IRA or a Roth 401k? Not sure? Not sure of the difference? Stick around. In this video, we'll be looking at Roth versus traditional pre-tax savings and the advantages and disadvantages of each. Stay tuned to Roth or not to Roth, coming up. It's Jeff Drayton, Certified Financial Planner Professional and founder of Jeffrey A. Drayton Financial Planning and Wealth Management, LLC. In these videos, I share my thoughts on financial planning topics for individuals and households. If you're watching this video on YouTube, don't forget to subscribe. And if you're viewing this from my website, fill out that sign-up form so that we can contact you when new content becomes available. Ever since the advent of the individual retirement account in the mid-1970s, and again shortly thereafter with the addition of the 401k, individuals have had the opportunity to save for their retirement pre-tax. Meaning, when you make contributions to IRAs, 401ks, and a number of other similar such pre-tax retirement accounts, you will not have to pay income tax on those contributed dollars in the year of the contribution. Furthermore, as these dollars remain in those accounts, receiving interest or collecting investment gains, all taxes on those gains are deferred until such time as you withdraw that money, presumably during your retirement. Right from the start, this has been enormously popular. You are literally being allowed to make money on dollars you would not have had otherwise, dollars that would have simply been lost to you had you been required to pay the income taxes in the year that this money was earned. However, there is a caveat. Those taxes have not gone away. They have simply been deferred until some point in the future. And to avoid paying a penalty on the withdrawal of that money, it has to be a point in the future after you have reached the age of at least 59 and a half. At that point, when you do withdraw those tax-deferred dollars, you will owe ordinary income tax on the entire amount of the withdrawal. And herein lies a bit of a dark side. In making tax-deferred contributions to your retirement account, whichever pre-tax retirement account type it may be, you have essentially traded the tax code of today, a known entity, with the tax code of some point in the future. And guess what? That's an unknown entity. This is a proposition that makes a great many people not altogether too comfortable. But in 1997, there came an alternative. Named after a late senator from Delaware, the Roth IRA was born, and some years later, its close cousin, the Roth 401k. With this type of account, things work quite a bit differently. There is no tax deferral of your contributions to the account. You will bear the full brunt of your current year's income tax when you make the contribution. However, presuming that you let your money stay in that account for the required length of time, not withdrawing it prior to reaching the age of 59 and a half, you will never pay taxes on that money again. Wow. So, which is better? Are you better off keeping more of your money now, allowing it to grow and collect investment returns, and defer the taxes until later? Or would it be better to simply bite that proverbial bullet and pay the tax bill, never having to worry about taxes on that money again? Well, unfortunately, this is a question that doesn't have a simple answer. And to show you what I mean, let's do an analysis. So here we go, Roth versus traditional. We'll assume that we are going to contribute $10K to our retirement savings this year. Maybe this is our 401k and we are trying to decide whether Roth or traditional gives us the best result. First of all, on the Roth side, we need to account for taxes. There is no current tax benefit for making a Roth contribution, so we need to subtract this year's income taxes on these dollars. I'll assume a 25% tax rate, giving us an effective contribution of $7,500. Now we need to assume a time horizon and investment return. In this scenario, the individual is approximately 30 years from retirement, and we are going to set as a target an 8% investment return. So, after 30 years, where are we at? On the Roth side, $7,500 at 8% return after 30 years will have grown to $75,470. However, on the traditional side, given that we started out with $2,500 more, here we will have accumulated $100,627. But remember, now we have to account for the tax consequences on the withdrawal end of our retirement accounts. On the Roth side, good news, there are no tax consequences. This money will be tax-free in retirement. However, on the traditional side, this will be taxed as ordinary income in the year that it is withdrawn. So I'll assume that same 25% tax rate that I used before. 25% of $100,627 is $25,157. Subtracted from our savings, guess what? We end up with a balance of $75,470. Exactly the same as what we would have had should we have chosen the Roth option. So, what does this analysis tell us? Possibly that there's no difference between Roth and traditional? For the answer to that, we need to look at the assumptions that were made in the analysis. And there were a few. On the one hand, there was the time horizon and investment return. However, those variables are not really consequential in that presumably you will have the same time horizon and investment options in either a Roth or a traditional account. Those variables will not change. What does differ between the two accounts is how they are taxed. Therefore, the variables that we insert for those numbers will make a difference. And here, there are two tax rates to account for. The first is the tax rate paid or saved when the retirement account contribution is made. In our example, this was the assumed 25% upfront tax bill that would be paid if one chose Roth Savings or saved if one chose a traditional pre-tax account. The second, of course, is the assumed tax rate to be paid when the dollars are withdrawn. Here again, I assumed a 25% rate. And the result was that the true after-tax value of the traditional pre-tax account was identical to that of the Roth. Therefore, what this analysis does tell us is this. When deciding between Roth or traditional accounts for retirement savings, if the upfront tax savings or bill were to be identical to the eventual retirement tax savings or bill, then the difference between the two accounts is inconsequential. The total after-tax savings will be identical. However, here is where the planning opportunity lies. The likelihood that those two tax rates will be identical is most probably quite small. Therefore, the obvious question is this: what is your situation? What would you have to pay now to have Roth savings today, and what do you anticipate your tax bill will look like at some point in the future, specifically during your retirement? To illustrate what I mean by this, let's look at an actual tax scenario, a case study of a married couple deciding which type of retirement savings will make the most sense for them. Here we have Tori and Max. And Tori and Max are strong wage earners, each earning approximately $150,000 a year for a combined household income of $300,000. I want to look at what Tori and Max's anticipated tax bill will be. And for this illustration, I'm using 2018 tax rules, and Tori and Max are going to be filing as married filing jointly taxpayers. So, Tori and Max will get a standard deduction of $24,000, meaning that they will pay $0 of tax on their first $24,000 of income. Next will be that portion of their income that will be exposed to the 10% tax bracket. That will be the next $19,050, which will give them a bill on that income of $1,905. After that is the 12% bracket, which will be applied to $58,349, which will cost them an additional $7,002 of tax. Then the 22% bracket, which will apply to the next $87,599. And finally is the remaining $111,002 of their income, which will all fall within the 24% tax bracket. If we total the left column of numbers, you can see that this now accounts for all the $300,000 of Tori and Max's income. Furthermore, if we total the right column of numbers, this will show us what Tori and Max's projected tax will be for 2018. We would anticipate that Tori and Max are going to pay $54,819 of federal income tax. When you receive your tax return from your CPA or some such tax professional, and you are curious what the tax rate is that you paid, you likely see a few numbers. As you saw, Tori and Max actually paid a number of tax rates, including the 0% rate that they paid on their standard deduction dollars. They actually paid 5 different tax percentages. However, I'm going to discuss the 2 rates that they are likely to see referred to when they get their return back from their tax preparer. The first is what we refer to as Tory and Max's marginal tax rate. This is the highest tax rate that they paid. In Tory and Max's case, this rate was the 24% that they paid on their last $111,000. And as their highest rate, should Tory and Max discover that they really made $300,005, not just $300,000, those extra $5 will get taxed at this marginal or highest tax rate. Any additional income comes in on the top and therefore will be taxed at their highest rate of 24%. However, another tax rate that they might see is what we call their effective tax rate. For our example, I'm going to apply an effective tax rate on their entire $300,000 of gross income. In this case, Tory and Max paid an effective rate of approximately 18%, which is the weighted average of each of the 5 tax percentages that their income was exposed to. So, what does this have to do with helping Tory and Max decide whether they should be saving their retirement dollars in a Roth account versus a traditional pre-tax retirement account? Well, the answer is everything. Imagine that Tory and Max have each decided that they are going to save 10% of their income this year for retirement. They each will contribute $15,000, presumably, to their employer's 401k retirement plans. And as it so happens, each of their employers offers both a Roth and a traditional option. Should they choose Roth Savings, we know that the primary consideration should be what is the tax rate that they will need to pay on those dollars at the time of the contribution versus what we would anticipate they will need to pay at the time of their retirement, when those dollars would come out. For Tory and Max, the answer to the first question is easy. They would need to pay 24%, their marginal tax rate. You see, if they do not choose Roth, but instead a traditional pre-tax account, those $30,000 that they contribute, $15,000 each, are going to effectively reduce their income for the year. In the eyes of the tax code, they will have only made $270,000 this year, not $300,000. That $30,000 contribution is going to reduce their current 2018 taxable income, and those dollars are going to come off the top. The tax rate that this $30,000 contribution will avoid will be Tory and Max's 24% marginal rate. However, in considering what Tory and Max's tax bill will be in the future, presumably some years or decades down the road when they have retired, it would likely not be appropriate to use a marginal tax rate in our analysis for that time. Why? Because during retirement, they are going to be drawing from their retirement accounts to create their post-retirement income. Should they have chosen to use pre-tax options for their retirement savings during their working years, presumably that money will be replacing the majority of their pre-retirement income when they have retired. It will be used to recreate their paycheck. It will be taxed as ordinary income. However, as such, like their pre-retirement income, it will presumably be exposed to all the tax brackets, not just their marginal rate, but also all those rates below. You know, I meet a number of clients who have received advice from their advisors to always do Roth savings, with no more justification than tax rates will likely go up in the future. Certainly rising tax rates in the future is a legitimate concern, especially given the changes that were made to the tax code for 2018. However, as a blanket statement, that really ignores much of the nuance that true financial planning sometimes requires. When tax rates change, they frequently do not do so evenly straight across the board. We can see that the headwind that Tory and Max will face should they choose Roth savings now is that they will have to pay their marginal or highest tax rate on these savings to get that money into their Roth accounts. They are fairly high wage earners, possibly in the upper wage earning years of their careers. Utilizing Roth savings now sets that preliminary tax bar high, making it much more difficult to realize a tax benefit later through the Roth account tax savings in their retirement years. That is not to say this would be a bad decision. They might have other justifications for choosing Roth over traditional. However, possibly, theirs is not the ideal situation in which to do so. So, what would be an ideal situation in which to utilize a Roth account? Well, certainly any time that one can put money into a Roth account without having to pay a high tax bill up front is an advantageous situation. Let me give you an example that is somewhat in the extreme. My son got a job this year at the beginning of the summer. He is now a barista at a local coffee shop. Having this earned income actually makes him eligible to contribute to an individual retirement account this year. Having earned income or being married to someone who does is a primary requirement to contribute to an IRA. Now, my son will likely not make enough money this year to actually have an income tax bill. Imagine if he were to take $1,000 of his earnings and start an IRA. If he were to retire at his current full retirement age for Social Security, that date is 50 years away. That $1,000 contribution at 8% interest over 50 years would result in a balance close to $47,000. If he chooses a traditional IRA, that $47,000 will be fully taxable in the year that he withdraws it from that account. The supposed benefit of the traditional IRA was that he would not have to pay taxes on the contributed dollars in the year that he makes the contribution. However, given the amount that he will earn, he likely isn't going to owe any taxes. Therefore, that benefit would be of no value to him. However, if he were to put that money in a Roth IRA, all $47,000 would be available to him tax-free in retirement, and again, there would likely have been no upfront tax cost for having done so. In his case, having chosen traditional over Roth would have been a grave error. His would be an obvious opportunity to use a Roth account. Yes, this was a fairly extreme example. However, anytime one has the opportunity to contribute to Roth savings without incurring a substantial tax bill at the time of the contribution, this is a situation that strongly favors a Roth. Maybe you are early in your career and your earnings are not yet such as to drive you too far up in the tax brackets. Or maybe you receive a tax-free windfall, such as a gift, an inheritance, or death proceeds from a life insurance policy, and you have the ability to contribute to a Roth IRA. These are all situations in which it would likely make great sense to consider Roth over traditional pre-tax options. Even higher wage earners potentially have means to achieve some amount of Roth savings at something less than their full marginal rate. However, in these cases, it likely requires advanced planning techniques that go beyond the scope of this video. One last point on Roth versus traditional savings. I would have a difficult time imagining a situation in which it would not be a recommendation for an individual to try to pursue a strategy of having some of both Roth and traditional pre-tax savings represented in their retirement portfolio. These two types of retirement savings are taxed differently, and which will be most beneficial is, to a large degree, dependent on what the tax code will look like at the time of your retirement. And as I said before, that's an unknown entity. Just as you would not want to have an investment portfolio that is entirely invested in a single asset or even asset class, you want some amount of diversification in your investment strategy. Having both Roth and traditional pre-tax accounts among your retirement holdings gives your retirement savings a diversification of tax profiles. This will give you and your planner some degree of flexibility with regards to how you might draw from those assets in retirement, potentially in a more tax-efficient way for both types of accounts. I'm Jeff Drayton. Thanks for watching. Hey everyone, as always, nothing in this video is meant to be specific advice for you. Advice like that can only be had by working with a financial planner, someone who knows you and your situation. I would encourage you to seek out someone who is a certified financial planner. This is signified by the letters CFP with the registered trademark sign following his or her name. I would also encourage you to work with a fee-only financial planner. Now that's two words, fee-only. Not fee-based, not fee plus commission. Both of those terms mean that the planner or advisor can receive commissions and is therefore not free of the conflict of interest inherent to commission sales. Again, I'm Jeff Drayton. Thanks for watching.